Hey, everybody. Today I want to talk about pairs trades. Now, some people would say that most people would maybe think that that means like foreign exchange pairs. But what we're talking about is pairs trading in stocks. And what this is where you buy one stock and sell a related stock. So, for example, buy Ford, sell General Motors. And basically, what you're looking for is you're looking for the relationship between the two stocks to change. So, using that example, if I buy Ford and sell General Motors, all I care about is will Ford outperform General Motors? Notice that I don't really care if the auto sector is bullish or bearish. I don't really care. All I care about is whether or not Ford gains on General Motors. Now, one of the cool things about this strategy is depending on your broker, you may have to come up with no money at all. In other words, if I short sell General Motors, I can use the proceeds from the short sale to pay for the long Ford position. So, in other words, if you're right on the trade, you actually can have an infinite return on equity. So, you got to check with your broker. All institutions can do this trade, absolutely no problem. But a lot of retail brokers will allow you to do it as well. So, check with your broker. Now, even if you have to, even if they won't allow you to use the money from your short sale, you still only have to come up with the money for the long side. So let's say I buy $5,000 worth of Ford and sell $5,000 worth of General Motors. In that case, I'm still looking for that change in the spread between the two, but I only have to come up with $5,000. I don't have to come up with any cash on the short side. But as I say, it's quite possible that they'll let you use the money from the short sale to pay for the long position. So what I want to do is I want to go through the anatomy of a trade that I'm going to put on, which is a pairs trade, to give you an idea of how you approach these types of trades, how you enter the orders, how you exit the orders, how you do risk management, because this can become a really nice low risk way of making money. And in particular, you can be making money during bear markets with no problem, and you can be making money in sideways markets. You don't really care. You don't need a big bull market to be making money. So let's take a look at some fundamental analysis to start with. Right now, the trade that I'm going to look at is Citibank versus US Bank. Citibank ticker symbol is C. US Bank is ticker symbol USB. So what we've got here is right now we know that Citibank is trading 30% below tangible book value. At the same time, US Bank is trading at a 300% premium to tangible book value. So Citibank looks cheap, US Bank looks expensive. And tangible book value literally means like the cash that they have on the balance sheet. Let's take a look at some other valuation premiums. And all we care about, we don't care if these banks are good banks, bad banks, best of the best, worst of the worst. All we care about is the relationship of the two to each other. Let's take a look at price to book. USB has a price of 34.12 and the book value is 17. So it's basically 2 times book value. But Citibank is almost 50% of book value. In other words, USB is valued 4 times higher than Citibank. How about price to sales? Citibank's price to sale is 151, USB's 365, twice the valuation. The forward PE on Citibank is 7.25. The forward PE on USB is 11.22. So about a 50% premium for the forward PE. So we've gone through a series of valuations which allow us to compare and contrast these two banks. Now, you could say, well, yeah, that's great, but USB is a better bank, and that's why it's worth more. And we can say, you know what, that's probably right. USB probably is a better bank. But the question is is the price gone too far? And has the price of Citibank gone too far on the downside? So we can't answer that necessarily from a fundamental point of view, although we can clearly see there's a huge divergence in the valuation between these two money center banks. So let's now take a look. We know that one is probably undervalued and one is probably overvalued. So now let's take a look at it from a technical point of view. Here we've got a chart. This is a daily chart. And let me explain it a little bit. You can see I've got all my channel breakout. I got all kinds of technical indicators. Please ignore those. The key here, though, is that what I have done is constructed a chart, a daily bar chart, where I've taken the price of Citigroup and divided it by the price of U.S. Bank Corp. So I'm not taking Citigroup and subtracting U.S. Bank Corp. I'm dividing by U.S. Bank Corp. So the chart is the ratio of the two stock prices. So as you can see, we've had a pretty significant bear market where the ratio went from about 122, went all the way down to just 0.75. But over the last month, we can see that Citibank has been consistently gaining on U.S. Bank Corp. So we have a short-term bull market, which I expect to continue going forward. Now let's take a look at it at a higher time frame because this chart looks reasonably constructive. Let's take a look at the same thing only from a weekly perspective. And here you can see that this is a major bear market in the ratio of the two stocks. However, those blue lines are a classic charting formation called a wedge formation. So, which tells us that there's a good chance that we've seen a bottom in the ratio. Not the end of the world. We can't conclusively say that. It's certainly not a weekly bull market. We need to get above those highs set earlier this year at around 122 before we can conclusively say that. But if we combine it with the daily chart, we can start to develop a trading strategy that can make us money if the bull market is continuing, yet control our risk if it's not. Now, just to put this in big perspective, now I want to blow your minds for a minute. There's the monthly chart. We're now down around 1, where the ratio of the two stock prices is about 1. But back in 2000, Citibank was trading for 35 times the price of U.S. Bank Corp. So you can see in the crisis of 2007, 2008, Citibank went from around 17, 18 down to 1. Now, do I think that this thing is going to rally up and we're going to go see 35? No. Do I even think we're going to go to 17? No. But what if we went to 2.5? That means we'd make a lot of money. And that would certainly be within the realm of just even random movement in this spread. So the next thing we have to figure out is how many shares are we going to put on? How many shares of Citibank are we going to buy? And how many shares of USB are we going to sell short? So let's take a look at this. When you do a pairs trade, what you do is you weight by dollar value, not the price of one minus the second one. There's a typo there. It should say second one, not second month. So let's take a look at that. So we want to have an equal dollar value of each of the two stocks. We want $5,000 of each or $10,000 of each or whatever we want. So the way we figure that out is we simply take the ratio. So right now, Citibank is at 32.86. USB is trading at 34.12 when I put this together earlier today. So the ratio is 96.31. Citibank trades for 96.31% of the price of USB. So what that means is we're going to buy 96.31 shares of USB for every 100 shares of C. And if we do that, we're going to have an equal dollar value of the two stocks. So we can use that ratio, 96.31, and you can, buy 50 shares, 100 shares, a billion shares, whatever, but you want to buy a slightly smaller number of shares of USB for every share of Citibank. So that's how we determine how many shares to buy of the two things. Now, how are we going to structure this trade? Well, this is where I'm going to get kind of tricky and a little bit clever. Here's a chart of Citibank earlier today. And you can see it's a nice looking chart, kind of grinding up higher. We've got a little flaggy type formation up here. Looks fine. It's okay. I'm digging it. So if I were to be a buyer of this stock, I'd probably want to buy it on a break to new highs up around 35.40, something like that. A classical chartist might look at this as a flag formation and buy it earlier, but I'm going to be a little bit more conservative and say that if I were to buy Citigroup, I'd want to buy it up around 35.40, a break of the highs of a couple of weeks ago. Now let's take a look at USB chart. Completely looking different. It looks pretty similar over the last couple of weeks, but the structure is obviously very different than the Citibank chart. Here we see there's Citibank, and here we have USB. So keep those charts in mind. I'll give you one more second here. There's Citibank. Keep that chart in mind. Now here's USB. Notice we actually made a low in the market yesterday. So here's the strategy that I would use on a pairs trading. Now, typically what happens is if I go to a guy who's a professional pairs trader, he's going to buy Citibank and sell USB in the ratio that I told you. But I like to do it a little bit different. So, and that strategy that I just mentioned is fine. Let's go back. If we see, if you do it the classic way, then you would simply use this chart of the ratio as the place to put your entry point and your stop loss. So in this case, probably buy a break to new highs. That probably means we can put a stop loss in roughly near today's low, something like that. But whatever technique you want to use, that's fine. That's the traditional classic way of doing pairs trading. But I never like to do things the way other people do it. So I want to show you the way I like to do it, which can make you a lot more money. So let's take a look at it. Let's take a look once again. Here's our Citibank chart. Here is our USB chart. So here's my strategy. What I'm going to do, this is how I'm going to put the actual trade on in the real world, is I'm going to buy Citibank only on a break to new highs. So if Citibank doesn't break to new highs, I'm never going to put this trade on. But if Citibank breaks to new highs, I'm going to buy Citibank. However, this is where it gets tricky. Pay very close attention. Make sure your pen's all warmed up here. My stop loss is going to be yesterday's low on USB. So check this out. So what's going to happen is this. Let's assume that the market breaks up and I buy Citibank. Now, my stop loss is going to be yesterday's low on USB. So I buy C. One of two things can happen. It either keeps on going up and I make a ton of money, or it starts to go down. And let's obviously we want the first one. That's the one we really want because we make a ton of money. But let's take the worst case scenario and let's focus more on that rather than on the glories of the first scenario. Let's focus on where we have potential risk. So what happens then is that the market sells down. I'm long Citibank. The market breaks yesterday's low on USB, and now I get short USB. So what I've done is I've done what's called legged into the strategy. I bought one leg, Citibank, and then I sold USB after that. So now I've got on my Citibank USB trade, which I said was my initial idea of the trade. And so, but what I wanted to do is I wanted to give myself the opportunity to make the maximum amount of money, which means I just want to buy C if it breaks to new highs. Now, what if it just goes down? Well, then I'm perfectly happy to go naked short selling USB and then use my stop loss on the short USB strategy as buying Citibank on the most recent highs. So in other words, I want to leg into the spread either by buying C with an initial stop at the recent low on USB, or I want to go short USB with a stop in C at the recent highs. of about, I guess, is about a week and a half ago. So that way we can leg into the spread. Now, once let's say we buy C and then we're quote unquote stopped out, but now we have the spread that we want, which is long C, short USB. We would look for this to come to a very, a much, we would look for that spread to make us money, not as much money probably as if we just owned Citibank outright, but nonetheless, we now have probably a very nice, profitable trade. Now, there's another really cool way that we could put this trade on. This is how I'm going to play this. This is not, as I say, the typical way that pairs traders. They just put on the pair at the beginning. I like to leg in instead because it can help me make a lot more money. Another way is, let's think about using options. So another possible option strategy is, what if we bought a call on C and bought a put on USB? Now, right now, this is a good strategy because options on Citibank and USB are cheap. We want to be a buyer of options right now. We do not want to be a seller of options in these. We want to be a buyer of options. Now, notice that what we're really doing, if we strip this down and buy a call on C, buy a put on USB, we're really buying a straddle on money center banks. And so as a result, we have the potential to make money on the market moving strongly in one way or the other. And we also can make money on an increase in implied volatility. And I'm pretty sure we're going to make money on that trade as well. I'm pretty sure that implied volatility is going to go up, and I'm going to make money on both the movement in the stocks and the movement in the implied volatility on the options, the two options that we have here. So this is kind of I'm getting comments like, that's just crazy enough to work. Hey, that kind of describes me. So what happens then is if we get short USB, we don't sell C, we get into the long C as the stop loss on the short USB. So I hope you enjoyed this video. There's a lot of deep thinking going on here. Obviously, you should probably review this video over and over again. It's the type of thing where you start to see layers and layers of strategy, thinking behind how this is going. But we're fulfilling nearly all the principles of good trading, of buying that which is strongest, selling that which is weakest. We've got a big edge on the fundamental side. Hopefully, what looks like a good edge on the technical side will hold. But the point is, this is a unique way of looking at the markets and making money in a much cleverer way that doesn't require us to be in a bull market at all. This is a way to make money in the stock market in sideways, bearish, bullish. Doesn't really matter. You'll notice we don't really care what direction the market goes, and we don't even care if it goes in any direction at all. Because we are bullish on the implied volatility on the options, we would want to go as far out as we can, as long as there is liquidity out there. So in order to do this type of analysis, I did all this using Yahoo Finance, absolutely free. And what you do is you basically go in and look at an industry where the stocks or the companies are very similar, and you simply say, well, let's take a look at some of the let's take a look, and you can say competitors, and it'll line them up for you, and you can see how to do that. You can see the comparison of the various banks and which ones are highly valued and which ones are lowly valued, if that's such a word. The chart that I did is on stockcharts.com, which is a free chart service, although I do recommend subscribing to it because it gives you all kinds of really cool things at a really cheap price. It's a cheap, good website. And you just simply put in C:USB, C:USB, and that gets you the ratio between the two things. For the options, I would go at the money options because that gives you the maximum profit from the changes in the implied volatility. All right, everybody, I hope you enjoyed this strategy. I have to go and now put the orders into the market for myself because I do need to go make some more money so I can get back into the pool. Thanks very much.